Hey, this is Ken Finnan, also known as a Series 7 Whisperer, and my job is to get you past the SIE exam, the Series 7 exam, Series 65, all the FINRA and NASA exams. So going forward, I'm going to be going a mix of like short little videos, long ones, maybe some podcasts about like interviewing some people who took the tests. But a lot of these are going to be where I use a external source to create a script and then I have somebody else read it because I stumble and mutter a lot. And I think these are working really well. So let's get into it and we're going to have some fun here. And before we get into it, let's talk about one thing. I do live Q&As every Tuesday night for the FINRA exams and every Thursday night for the NASA exams, 8 p.m. Eastern on YouTube. Come have fun, ask questions about whatever you want, celebrate the wins, commiserate with the losses, but meet me every Tuesday night for FINRA stuff, every Thursday night for NASA stuff live on the tube of you, and we can get this done, baby. Let's go.
Imagine for a second handing a financial institution like $100,000.
Okay, $100,000. That's a lot of money.
Right. And they look you straight in the eye and tell you, hey, you can invest this money directly into the stock market.
Which is risky.
Exactly. But they say if the market goes on this massive, 10-year bull run, you capture all that upside.
Sounds great so far.
Yeah. But here's the crazy part. They also say if the global economy suffers this catastrophic, 2008 style crash on the exact day you die.
Oh, wow.
Your family doesn't lose a single penny of that original investment.
I mean, it sounds like financial magic, honestly.
Right. Or, if you're a naturally skeptical person, it sounds like a complete scam.
It definitely sounds too good to be true when you just, glance at the marketing brochure.
Oh,
I mean, a floor on your losses, but unlimited upside potential. That totally defies everything we're traditionally taught about, the relationship between risk and reward.
which is exactly why we are pulling out the magnifying glass today. So welcome to this deep dive.
Glad to be here.
We have got a massive stack of research on the table today. I mean, we're looking at everything from dense Series 7 exam prep materials to actual heavily regulated variable annuity prospectuses.
And those are not light reading.
No, they are not.
Yeah.
And our explicit mission today is to cut through all that heavy industry jargon, right? We want to crack the code on how these hybrid insurance products actually work in the real world.
We're looking specifically at variable life insurance and variable annuities today.
Exactly.
And we really need to translate this textbook theory into plain English.
Yes, please.
I mean, that's crucial if you are listening to this while studying for your licensing exams. But it's equally vital if you're simply trying to figure out if one of these products actually belongs in your own retirement portfolio.
Because the financial services industry, they just love complexity, don't they?
Oh, they thrive on it. And these products are arguably the most complex vehicles available to the retail investor today.
I mean, I'm looking at this stack of prospectuses right now,
Mm-hmm.
and they are literally thick enough to stop a bullet.
They're huge.
You open them up, and you're immediately hit with these terms like annuitization units or mortality and expense risk charges.
LIFO tax treatment.
Yes, LIFO. It is just a wall of intimidating text. So we're going to tear that wall down today.
Let's do it.
We're going to explore how the money actually grows in the background. We'll break down the fees, because, there are always fees.
All right.
We'll look at how the IRS taxes the payouts. And ultimately, we're going to figure out who should actually be buying these things.
Well, before we can even look under the hood at those complex features, we have to examine the chassis that this whole thing is built on.
Okay, where do we start?
We have to understand the fundamental difference between a fixed financial environment and a variable environment.
Right.
Because if you don't know where the money physically lives when you hand over that initial check, nothing else in the contract is going to make any sense.
So let's start with the traditional route, just to set a baseline. Let's say I go out and buy a standard fixed annuity.
Okay.
I hand the insurance company my $100,000.
Sure.
I assume they don't just put it in a giant vault with the cartoon dollar sign on it.
No, definitely not a cartoon vault.
So where does it go? And what is the promise they are making me?
When you buy a fixed product, you are fundamentally buying a guarantee.
A guarantee of what?
The insurance company is contractually promising you a specific stated rate of return.
Okay, so give me a number.
Let's use 4% as our baseline.
Okay, 4%.
Right. So no matter what happens in the stock market, no matter if inflation spikes, no matter what happens in the global economy, they owe you that 4%.
Wow.
Because they are making that ironclad guarantee, the insurance company bears 100% of the investment risk.
So if the stock market totally crashes and burns, I still get my 4%.
You still get it.
But what if the market goes on a historic tear and goes up 30% in a year?
You don't get any of that.
None of it.
None. You still just get your 4%.
Okay, so the trade-off for that safety is basically a hard cap on your potential wealth.
Exactly. And because the insurance company is taking on all that risk, they take your $100,000 and they pool it into what is called their general account.
The general account. Okay,
Yeah.
this is a term that comes up constantly in the Series 7 source material.
It's foundational.
What is actually inside that account? I mean, physically.
The general account is the insurance company's massive, highly conservative investment portfolio.
Because they can't lose the money.
Right. To guarantee you that 4%, they absolutely cannot afford to be playing the stock market casino with your cash.
That makes sense.
So the general account is primarily made up of highly rated corporate bonds, long-term government securities, maybe some commercial real estate mortgages.
Boring stuff.
Very boring. It is designed to be slow, steady, and incredibly predictable.
So they just manage that massive pool of bonds.
Yeah, the company employs armies of actuaries and bond managers to ensure the yield on that general account outpaces the 4% they promised you.
Oh, I see. So if they make 6% on the bonds and pay me 4%.
The 2% difference is their profit.
Okay, that makes perfect sense for, a conservative investor who just wants to beat inflation and sleep at night.
Sure.
But our stack of research today is focused on variable products.
Right, variable life insurance and variable annuities.
So when we introduce that word variable, how does that underlying architecture actually change?
The architecture completely flips.
Flips how?
In a variable product, the insurance company is no longer guaranteeing you a specific rate of return on your investment.
No 4% guarantee.
No guarantee at all. The return will fluctuate. It will vary based entirely on the performance of the financial markets.
Okay.
So in this scenario, you, the investor, are the one bearing the investment risk.
So if the market crashes, my account value crashes right along with it. But if the market goes up 30%, my account captures that 30% upside.
Exactly. You get the upside. But because you are the one taking the risk, and honestly, more importantly, because you are the one choosing how aggressively or conservatively the money is invested,
Yeah.
your money legally cannot go into the insurance company's general account.
Oh, interesting. So they can't mix it with the safe bond money.
They cannot. It is placed into something called the separate account.
The separate account.
Yeah.
Okay, if you are studying for the Series 7 right now, highlight this term, underline it, put a huge star next to it.
For sure.
Because from what I'm reading, the separate account is basically the entire engine of a variable contract.
It is the absolute core of the product. The separate account is, well, exactly what the name implies.
It's separate.
It's a segregated, legally distinct pool of money that is entirely walled off from the insurance company's general account.
So when I write my check for a variable annuity,
The funds drop directly into the separate account. And from there, you are given this menu of options to allocate your money into different sub-accounts.
sub-accounts. Okay, looking at these prospectuses here, the sub-accounts just look like a standard list of mutual funds.
That's the easiest way to think about them.
Like I'm seeing a large cap growth sub-account, an international bond sub-account, maybe a money market sub-account if I just want to hold cash.
Right. For all intents and purposes, you can just think of them as mutual funds wrapped inside an insurance contract.
Oh, okay.
They hold baskets of stocks and bonds, they have professional portfolio managers, and they have daily fluctuating prices.
And so the performance of those specific sub-accounts that I pick.
That performance will dictate the ultimate final value of your contract.
Okay, I understand the mechanics of separating the money based on, who is taking the risk.
Right.
But why go through all the trouble of creating this literal legal wall between the general account and the separate account? Like, why not just track it on a massive spreadsheet at the corporate office?
What's really fascinating here is the legal and regulatory history behind why the separate account was actually created in the first place.
Okay, history lesson. Let's hear it.
It acts as a structural regulatory firewall.
A firewall against what exactly? Hackers?
No, against the insurance company going bankrupt.
Oh, wow. Okay.
Let's imagine a scenario where the executives at this insurance company make just a series of terrible corporate decisions.
Like they usually do.
Right. Maybe they misprice a massive block of those fixed annuities we talked about, or they suffer catastrophic losses on their real estate portfolio.
Okay, so the company's bleeding money.
And the company goes completely belly up. They declare insolvency.
Yikes.
Their creditors are going to come knocking, looking to liquidate the company's assets to get their money back.
Obviously.
And those creditors can absolutely go after the assets sitting in the general account.
Wait, really? So the people who bought the safe fixed annuities?
Could potentially lose their money or at least face severe haircuts if the company folds.
That is terrifying.
Now, it has happened historically, though I should note that state guarantee associations usually step in to mitigate some of that damage.
Okay, good to know.
Yeah.
But what about the variable side?
Here is the critical difference. By federal law, specifically under the Investment Company Act of 1940,
Good exam fact there.
yes, the creditors cannot touch the assets in the separate account.
The creditors are locked out.
Completely locked out. The separate account is legally structured to protect investor assets from the corporate liabilities of the insurer itself.
Wow.
It exists for the exclusive protected benefit of the policyholders who have their money in it.
That is a massive distinction.
It really is.
So this structure basically allows clients to chase higher yields in the stock market
Right.
without exposing their life savings, their nest egg, to the corporate risks of the actual insurance company that sold them the product.
Exactly. Even if the company files for bankruptcy tomorrow morning, your shares in that large cap growth subaccount are totally safe.
It's a beautifully designed legal structure, honestly. It provides a very specific type of security.
It does.
You know, I like to think of this structural difference in terms of transportation.
Okay, let's hear the analogy.
If you buy a fixed contract where your money lives in the general account, it is like riding a train on a track.
A train. Okay.
The ride is smooth. It is predictable. You know exactly what time you're going to arrive at the station because the schedule is guaranteed.
Right.
But you cannot steer the train, and the speed is strictly set by the conductor, which is the insurance company.
The insurance company owns the train and the tracks.
Exactly. Now, a variable contract where your money is in the separate account is more like taking a rugged off-road vehicle out into the wilderness.
I like this.
You have the potential to go much further, maybe much faster, by navigating all this different terrain. Those are the different mutual fund sub-accounts.
Right, you pick the terrain.
You get to choose the path, but you are the one driving.
And taking the risk.
Yes. It is going to be a much bumpier ride. You're going to hit potholes, and you assume the entire risk of the vehicle just breaking down. But you have total control over the destination.
That's a great analogy. And if we connect this to the broader regulatory picture, especially for the exam folks listening, that analogy highlights a really crucial regulatory reality.
What's that?
Because you are driving that off-road vehicle, because you are the one taking the investment risk, variable annuities and variable life insurance are legally classified as securities.
Right. They aren't just insurance policies.
Exactly. Fixed annuities are solely insurance products. They're regulated by state insurance commissioners.
But variable
They're both insurance and securities.
dual classification.
Yes. That means the financial professional selling them must hold a life insurance license, A&D, a securities license.
Which is typically the Series 7 or the Series 6, right?
Exactly. Furthermore, the products and the actual sales practices are regulated by both the state insurance commissioners and by federal entities like the SEC and FINRA.
So dual oversight.
Very strict dual oversight.
Which makes total sense.
Yeah.
Because you are directly interacting with the volatility of the stock market.
Absolutely.
But let me push back on this entire concept for a second.
Go for it.
If I am the one taking all the risk in this separate account,
Right?
and I am the one picking the sub-accounts that act exactly like mutual funds, why on earth am I buying an insurance product?
That's the million-dollar question.
Like, why wouldn't I just open a standard brokerage account at a firm like Fidelity or Vanguard, buy mutual funds directly, and just cut out the insurance middleman entirely?
That is the pivotal question, and frankly, it is the question every single investor should ask before signing these contracts.
So what's the answer?
To answer it, we have to look at what wraps around that separate account.
The wrapper.
Yeah, the
Right.
separate account doesn't exist in a vacuum. It is encased, wrapped in this thick layer of insurance guarantees and features.
Okay.
And that wrapper is exactly what makes these products unique, distinguishing them from just a pure brokerage account.
This brings us to the actual mechanics of the contract itself, right? We need to explore the guarantees, the benefits, and the riders.
Because if you are just buying mutual funds in a standard brokerage account, there is zero safety net.
None. If I buy a tech fund and the tech sector goes to zero, my account value goes to zero. End of story.
The brokerage firm is certainly not going to bail you out.
No, Charles Schwab is not writing me a check to apologize.
Exactly. A pure investment account is ruthless in that regard. But with a variable life insurance policy or a variable annuity, you are buying an insurance contract first and foremost.
And insurance is all about risk transfer.
Right. The fundamental purpose of insurance is transferring risk from the individual to a larger pool. So the actuaries at the insurance company build in specific characteristics to protect you, the investor, at least partially, from the very market risk you just willingly took on in the separate account.
Okay, let's break down those safety nets, because this is where the magic trick I mentioned in the introduction really comes into play.
Let's do it.
Let's start with the most basic protection: minimum guarantees.
Okay.
How does a minimum guarantee functionally work if the investment itself is completely variable and at the mercy of the market?
Let's use variable life insurance as our first example here.
Sound good.
The reason you buy a variable life policy rather than, say, a whole life policy is because you want the death benefit to grow over time as the stock market grows.
Hopefully outpacing inflation.
Exactly. You pay your premiums, and that money goes into the separate account. If the market goes up over the next 20 years, your death benefit increases.
That is the goal. I want my family to get a massive payout that grew with the economy.
But what if you time it terribly?
Story of my life.
Right. What if the market drops 40% right before you suffer a fatal heart attack?
Oh, man.
If this were a pure investment account, your family would be left with a fraction of what you originally planned to leave them.
Which defeats the purpose of the life insurance.
Exactly. So to prevent that catastrophic scenario, the insurance company provides a guaranteed minimum death benefit.
Often abbreviated as the GMDB.
Yes.
So it acts as a floor.
Mm-hmm.
The market can drop the ceiling, but it can't drop the floor.
Precisely. The contract will explicitly state that regardless of how terribly the separate account performs, the death benefit paid to your beneficiaries will never, ever fall below a certain base amount.
Okay.
This is usually the initial face amount of the policy when you first sign the paperwork.
Let me put some specific numbers to this just to make sure I have the mechanics exactly right, because I know this is a highly testable concept on the Series 7.
Very testable. Let's hear the scenario.
Okay, let's say I am 40 years old and I buy a variable life policy with a base face amount of $200,000.
Okay, $200K base.
Over the next 10 years, my separate account sub-accounts do amazingly well, and the death benefit organically grows to $300,000.
Great market run.
If I die in year 10, my family gets $300,000, correct?
Correct. They get the higher stepped-up amount based on the market performance.
But let's look at the nightmare scenario. Let's say year 11 rolls around, and a massive glowing recession hits.
The market tanks.
The market completely tanks. The actual cash value of my separate account drops so low that mathematically, it only supports a death benefit of $150,000.
Ouch.
Yeah. If I die in year 11, what does my family actually receive?
Your family receives the guaranteed minimum. They get the original $200,000.
Wow. Even though the account is only worth $150K.
Right. The insurance company is contractually obligated to make up that $50,000 shortfall out of their own pocket.
That's amazing.
And just to tie it back to our earlier discussion, that $50,000 comes directly out of their general account reserves.
Oh. It comes from the safe money.
Exactly.
That is a massive benefit.
Yeah.
You are effectively insuring a stock market portfolio against death during a bear market.
That's a great way to phrase it.
And this same conceptual floor applies to variable annuities as well, doesn't it?
It does.
Like if the person who owns the annuity dies before they actually retire and start taking payouts, there is a death benefit protection for the beneficiary, right?
Yes, the mechanism is very similar. For a variable annuity, during what we call the accumulation phase.
Meaning the years you are actively putting money in and letting it grow.
Right. If you happen to pass away during that phase, your beneficiary typically receives either the total amount of money you originally invested or the current market value of the account, whichever is greater.
Whichever is greater. Those are the magic words on the exam.
Absolutely.
So again, if I invest $100,000 into a variable annuity, allocate it aggressively, and the market crashes to $60,000.
Which happens.
And then I unexpectedly pass away, my beneficiary doesn't inherit a $60,000 account.
No, they get the original $100,000 back.
The insurance wrapper completely eliminates the risk of your heirs inheriting a financial loss if you happen to die during a market downturn.
It is a really powerful estate planning feature.
Okay, those are death benefits. That protects my family if the worst case scenario happens and I die.
Right.
But What if I don't die?
That's usually the goal.
Right. What if I live a very long, healthy life, but I still want some kind of safety net on my aggressive stock market investments while I am actually alive to enjoy them?
That specific desire is exactly what gave birth to the world of living benefits and riders.
Riders. Let's define that.
In insurance terminology, a rider is simply an optional add-on feature that you can purchase to customize a basic insurance contract for your specific needs.
It legally rides on top of the main policy document.
Exactly. It's an add-on.
And from what I see in the financial news, these living benefit riders have really become the primary selling point for variable annuities over the last 2 decades.
They absolutely revolutionized the industry.
How so?
Well, think about it. Before these living benefit riders were introduced in the late 90s and early 2000s, variable annuities were a much harder concept to sell to a retiree.
Why is that?
Think about the psychological barrier. You are asking a 60-year-old to put their life savings into the stock market.
Right.
If a prolonged bear market hits early in their retirement, their portfolio could be completely wiped out, leaving them destitute.
That's a huge fear.
But then, the insurance actuaries introduced innovations like the Guaranteed Minimum Income Benefit, or GMIB.
The Guaranteed Minimum Income Benefit. Walk me through the mechanics of how this actually protects a living retiree.
Essentially, a GMI guarantees that no matter how terribly the stock market performs,
Even if it crashes.
even if it completely crashes,
Yeah.
when you are finally ready to retire and start drawing income, your income will be calculated based on a guaranteed minimum growth rate rather than your actual depressed account balance.
Okay, that sounds a little complicated.
Yeah.
Let's use an example.
Let's do it.
Let's say I invest $100,000 at age 50.
Okay, you invest $100,000. Let's say the GMIB rider you purchase guarantees a 5% annual compound growth rate.
Okay, 5%.
But this is crucial. It only guarantees that rate for the purpose of calculating your future income.
Oh, not cash in hand.
Right. So over the next 15 years, let's pretend the actual stock market is just flat or even loses a little money.
A lost decade and a half.
Exactly. You look at your actual separate account statement when you turn 65, and your real cash value is only $80,000.
So if I wanted to just, cash out and walk away right then, I would only get $80,000. I lost money.
Correct. You would take a loss.
Okay.
But because you bought the GMI rider, the insurance company has been tracking a second phantom number in the background all these years.
Phantom number.
Yes. This is called your benefit base.
Oh,
Your original $100,000 has been growing by that guaranteed 5% every single year in this phantom account.
even though the real market was flat.
Right. So by age 65, that benefit base has grown to over $200,000.
Okay, wait. So my real cash is $80,000, but my phantom benefit base is $200,000.
Yes,
That's a huge difference.
it is. And when you decide to turn on the income stream, the insurance company is legally required to calculate your monthly retirement check based on that $200,000 phantom number.
They just completely ignore the fact that my real account is bleeding out at $80,000.
They completely ignore it.
That is wild.
Yeah.
It basically allows you to invest aggressively in the stock market for potential upside, but gives you a mathematically guaranteed floor for your actual retirement income.
Exactly. It creates this immense psychological safety net. You don't have to panic during a recession because your future income stream is totally insulated.
Okay, I have to stop you here.
Uh-oh.
I am putting myself in the shoes of a skeptical consumer right now.
Always a good idea.
You are describing a financial product that gives me unlimited upside potential in the stock market through the separate account.
Right.
It guarantees I will never lose my principal if I die. And it guarantees me a steadily growing income stream for retirement, even if my investments completely tank.
That is the value proposition, yes.
A floor on my losses, a guaranteed income, and unlimited upside.
Yeah.
What is the catch? Because Wall Street does not hand out free lunches.
No, they certainly do not. The catch, as with absolutely everything in the world of finance, is that guarantees are never free.
Right.
And the stronger, more comprehensive the guarantee, the higher the cost. That protective insurance wrapper we just spent all this time discussing.
Yeah.
It is incredibly heavy, and it is phenomenally expensive to maintain, which brings us directly to the reality of the costs involved.
We need to talk about the price of admission. The fees, the penalties, and the surrender values.
Because the insurance company isn't running a charity.
No, they are not. They have entire floors of corporate headquarters just filled with actuaries calculating the exact probability of having to pay out those death benefits and income guarantees, right?
Right. Absolutely. The actuaries run literally millions of Monte Carlo simulations to figure out exactly how much they need to charge every single policyholder to ensure the insurance company remains profitable, even if the global market crashes.
And I'm guessing they pass those costs on.
They pass every single penny of those projected costs directly on to you, the investor, in the form of internal fees.
If I am reading the prospectus of a typical variable annuity, I am obviously looking for the fee table.
It's usually a long table.
Let's break down this laundry list, because this is where variable annuities catch the most intense criticism from financial journalists and, consumer advocates.
Oh, for sure.
What exactly am I being charged for?
The biggest fee, and the one that is entirely unique to these insurance-wrapped products, is the mortality and expense risk charge.
Okay, mortality and expense.
You will almost always see it abbreviated on the exam and in the prospectus as the M&E fee.
The M&E fee, let's dissect that. What exactly am I paying for with the mortality part?
The mortality portion pays for the death benefit guarantees we discussed earlier. Okay. It compensates the insurance company for the actuarial risk that you might die when your account value is significantly lower than your guaranteed death benefit.
Oh, like the scenario where my account was $150K, but the guarantee was $200K.
Exactly. They are pooling the mortality risk of thousands of investors. If the market crashes and 100 policyholders die that year, the insurance company has to make up the difference.
So your mortality fee funds the reserve pool that pays out those exact claims.
Precisely.
So it is essentially just a life insurance premium embedded directly into my investment account.
That's exactly what it is. Now, the expense portion,
Yeah, what's that?
that compensates the insurance company for the risk that their internal administrative costs to run the contract might go up over the next 20 years.
Like inflation, rising salaries, technology upgrades.
Right. But they are legally bound by the contract not to increase your base administrative fees beyond a certain stated point. So the expense risk fee is basically their long-term inflationary buffer.
Got it. And how heavy is this M&E fee typically? Are we talking a fraction or percent?
Usually not a fraction, no. It varies by company and contract, but it is routinely around 1.25% of your total account value.
1.25%.
And that's automatically deducted every single year.
1.25% every year, just for the M&E.
Just for the M&E.
Oh, wow.
Next, you have standard administrative fees, which might be, a flat $40 or $50 a year for mailing statements and customer service.
Standard stuff.
Then you have the fees for the actual investments, the sub-accounts inside the separate account.
Right, because those are basically mutual funds, and every mutual fund has its own management fee, the expense ratio, to pay the portfolio managers who are actually picking the stocks.
Exactly. Depending on whether you choose cheap index funds or extensive actively managed funds, those sub-account fees might add another 0.5 to, frankly, over 1% to your annual cost.
Okay, this is adding up.
And we aren't done. Finally, if you chose to add on one of those fancy living benefit riders we talked about, like the guaranteed minimum income benefit.
The phantom account thing.
Yeah. The insurance company charges a separate fee just for that rider.
Of course they do.
That's going to cost you another 1 to 1.5% annually.
Okay, let me do some quick mental math here because the drag is starting to look pretty severe.
It's heavy.
1.25% for the M&E. Let's say 0.75% for the mutual fund subaccounts. That puts us at 2%.
Right.
Plus another 1% for the income rider. We are easily looking at 3% a year in total internal fees.
3% a year is a very realistic, sometimes even conservative total cost for a feature-rich variable annuity.
3%. If the stock market averages, let's say, an optimistic 8% a year over the long term,
Yeah.
I am giving up nearly 40% of my total potential growth just to pay for the insurance wrapper and the guarantees.
It's a massive drag.
Over 20 years, the difference between paying a 0.5% fee in a standard brokerage account and a 3% fee in an annuity. I mean, that could be hundreds of thousands of dollars in lost compounding growth.
That mathematical reality is exactly why these products are so heavily debated and scrutinized by planners.
I can see why.
You are buying peace of mind, you are buying a floor, but it acts as a massive, relentless drag on your investment performance. You are paying a premium for certainty.
Okay, so let's say I buy one of these anyway. I get a year or two into it, I look at my statement, I see the fees just eating my returns, and I decide, you know what, this was a mistake.
You want out.
Yeah, I want my money back. I want to cancel the whole contract and put my money in a cheap index fund. Can I just call them up, take my money, and walk away?
You can, but it is going to be incredibly painful.
Painful how?
This introduces a critical concept for the Series 7 and for real life. Surrender fees, or what the industry formally calls a contingent deferred sales charge, or CDSC.
Contingent deferred sales charge.
Yeah.
That sounds like a legally sterilized way of saying a massive penalty for leaving early.
That is exactly what it is. Annuities are designed to be long-term, illiquid investments in their early years.
Illiquid?
You have to understand the business model. When you buy a variable annuity, the insurance company typically pays the broker or advisor who sold it to you a very large upfront commission.
How large?
Sometimes 5, 6, or even 7% of your total deposit.
Wow. Okay, so the broker gets a huge payday on day one.
Right, but the insurance company hasn't actually made any money yet. They just paid out a massive commission.
So they're in the hole.
Exactly. They plan to slowly recoup that commission over the next decade by collecting that 1.25% M&E fee year after year. So if you bail out and cancel the contract after just 2 years, the insurance company is deep in the red. They lost money on the deal.
So the surrender fee is basically their mechanism for guaranteeing they get their money back if I break the contract before they have had time to milk the M&E fees.
Exactly. The surrender fee schedule usually starts very high, often matching the broker's commission, maybe 7 or 8% of your total account value.
Brutal.
And then it slowly steps down, declining by about 1% each year, until it hits 0 over a set schedule, usually 7 to 10 years.
You know, I always compare surrender fees to breaking a lease on an apartment or maybe trying to get out of a really rigid cell phone contract.
Yeah, that makes sense.
You can leave, you are not a prisoner, but the company is going to make it very painful financially to do so. They have sunk costs, and they're going to force you to cover them.
That's a perfect real-world analogy. So if your account is worth $100,000 and you attempt to cancel the contract in year 2 when the surrender fee is, say, 7%.
I do not get a check for $100,000.
No, you do not.
I get hit with a $7,000 penalty right off the top.
Right. The amount you actually walk away with is called the surrender value. It is a simple formula, account value minus the surrender fees.
So in this scenario, my surrender value is $93,000.
Yes. You lost $7,000 just for changing your mind. Ouch. Yeah, it hurts.
Before we move on from the features and fees, I do want to touch on one more specific rider, usually found on variable life insurance because it is heavily tested.
Okay, which one?
There is something called the waiver of premium, right? Because with life insurance, unlike an annuity, you usually have to keep making ongoing premium payments to keep the policy active.
Yes, you do. And the waiver of premium is a very common, very valuable rider on variable life policies.
How does it work?
It explicitly states that if the policyholder becomes totally disabled and cannot work for a sustained period, the insurance company will step in, waive the required premium payments, and actually keep the policy fully funded and active out of their own pocket.
That is a fascinating feature. It really highlights the hybrid nature of this whole system.
It does.
If I get into a horrible car accident and become disabled, a standard brokerage firm like Charles Schwab isn't going to step in and keep funding my mutual fund account for me.
They absolutely won't. They don't care.
But the insurance company will.
It's a perfect example of how an insurance feature provides a specific type of behavioral safety net that a pure investment account just doesn't offer.
Okay, that is a fair point. But, I have to go back to the math. I am struggling with the physics of this investment.
To 3% drag.
Yeah. If the internal fees are this heavy, 3% a year, dragging down the portfolio, plus the threat of massive surrender penalties locking up my liquidity, how do we ever actually make money in these accounts?
It's a fair question.
How is the day-to-day growth even measured?
It is a steep hill to climb, but despite the fees, the underlying investments in that separate account are quietly accumulating wealth over time, assuming the broader stock market trends upward.
Okay.
But because of the insurance wrapper, They measure that growth in a very specific technical way using a concept called units.
Units. Okay, let's talk about the accumulation phase, building the nest egg.
Right.
I open a variable annuity. I write a check for $50,000. What mechanically happens to that money the moment it clears?
When you are in the accumulation phase, the phase where you are depositing money and letting it sit and grow, you are purchasing what the industry calls accumulation units.
Accumulation unit.
Yes. Conceptually, you can think of an accumulation unit as being exactly the same as a share of a mutual fund.
Right.
When you put $50,000 into the contract, you are buying a certain number of accumulation units in the specific sub-accounts you selected.
Okay, so if the large cap growth sub-account is currently priced at $10 an accumulation unit, my $50,000 buys me exactly 5,000 units.
Exactly. And the value of those units changes daily based on the performance of the underlying stocks and bonds inside that sub-account, minus a daily micro-deduction for all those fees we talked about.
So it's net of fees.
Right. This is called the net asset value, or NAV. If the market goes up, the NAV of your accumulation unit might go up from $10 to $11.
And now my 5,000 units are worth $55,000.
It is identical to mutual fund accounting. You own a fixed number of shares, and the price of the shares fluctuates.
It is functionally identical.
Now, for the exam, you also need to understand how the sales charges might be impacted by the size of your deposits.
Oh, like volume discounts.
Yes. You need to know about something called the right of accumulation, or ROA.
Right of accumulation. I know this applies to standard mutual funds too. This is about getting that volume discount if you invest enough money. Right.
Correct. For variable products that utilize a front-end sales charge.
Meaning you pay a fee on the money as it goes in rather than a surrender fee when it comes out.
Exactly. The right of accumulation allows an investor to qualify for a reduced sales charge based on the total aggregate amount of money they have invested with that company over time.
So if there's a break point, a fee discount that kicks in at $50,000.
Right. And I already have $40,000 sitting in the account, and I decide to deposit another $10,000.
You get the discount.
I get the discounted fee on that new $10,000 because my accumulated total just crossed the $50,000 threshold.
Exactly. It is a loyalty program. It encourages clients to consolidate all their assets with one single insurance company rather than spreading it around.
Okay, I understand units and breakpoints.
Yep.
But we still haven't answered my biggest question.
Which is?
How does this math actually work out in favor of the investor if the internal fees are dragging it down by 3% a year? I mean, it feels like running a marathon with a 30-pound backpack.
If we connect this to the bigger picture, the answer lies in what is arguably the most powerful force in the tax code, tax deferral.
The tax wrapper. We haven't talked about the IRS yet.
And the IRS is the secret sauce of the annuity.
Let's hear it. Let's compare a variable annuity to a standard taxable brokerage account. If you hold mutual funds in a standard brokerage account, and those funds pay out annual dividends or the fund manager sells stocks and generates capital gains, you have to report that and pay taxes on that growth every single year.
Even if I don't withdraw the money, even if I just reinvest the dividends.
Even if you reinvest every single penny. It's called tax drag. Depending on your tax bracket, you are losing a significant percentage of your growth every year to Uncle Sam.
Right.
But a variable annuity is legally classified as a tax-deferred vehicle.
Okay.
The investments inside the separate account grow without any annual tax drag. No taxes on dividends, no taxes on capital gains.
Right.
You do not pay a single dime in taxes until you actually take the money out of the contract years down the road.
So my money is compounding, and the money that would have gone to pay taxes is also staying in the account, compounding and earning even more money.
Exactly. And over a period of 20 or 30 years, the mathematical power of tax-deferred compounding becomes exponential.
Wow.
That uninterrupted compounding curve is the primary mathematical defense against those high M&E fees.
So it's a race. The tax deferral is pushing the account value up faster than a taxable account, while the high fees are constantly pulling the value down.
That is a brilliant way to visualize it. It is a tug of war. And this is exactly why the time horizon is so critical.
Why?
Because the math of tax deferral only beats the drag of the high fees if you leave the money alone for a very long time.
Oh, I see.
If you buy a variable annuity and surrender it 5 years later, the fees will have eaten you alive, and the tax deferral won't have had nearly enough time to work its magic.
It really emphasizes that these are highly specialized retirement vehicles. They are designed for decades of quiet growth.
Decades.
They are not for short-term trading, and they are absolutely not a place to park your emergency fund.
Absolutely not. They require extreme patience.
Okay, so let's say I've been patient. I've done it right. I've funded this account for 30 years. The tax-deferred compounding has worked its magic and outrun the fees. I have this massive mountain of accumulation units sitting in my account.
You're ready to retire.
I am 65, I am retiring, and I am ready to start spending this money. What happens next?
When you are finally ready to retire and draw on income, you undergo a massive fundamental contractual shift.
Okay.
You transition from the accumulation phase to the payout phase. You trade your accumulation units in and you annuitize the contract.
Annuitization. Turning the tap on. This word annuitize, it literally means to turn a lump sum of money into a series of ongoing periodic payments, right?
That is the textbook definition. But what you really need to understand is that when you annuitize, you are making an irrevocable decision.
Irrevocable, meaning I can't change my mind if I wake up tomorrow and regret it.
You absolutely cannot change your mind.
Wow.
Once you sign the annuitization paperwork, you legally hand your entire massive pile of accumulation units over to the insurance company.
Just hand it over.
They own the lump sum now. In exchange, they convert those units into what are called annuitization units, and they promise to pay you an income stream based on the option you select.
So accumulation units magically transform into annuitization units.
Correct. And the moment that transformation happens, you no longer have a liquid lump sum of cash that you can just go in and withdraw to buy a boat.
My boat money is gone.
You cannot cash out the account anymore.
Yeah.
You have permanently traded your liquidity for a guaranteed stream of income.
That is a terrifying commitment, honestly. You are handing over your entire life savings for a promise of a monthly check.
It is a massive psychological and financial commitment. Now, it is worth noting that some clients skip the accumulation phase entirely.
Oh, really?
Let's say someone inherits a large sum of money or sells a small business for $2 million. They might hand that lump sum over to the insurance company and buy what is called an immediate annuity.
Oh, so they don't wait 30 years. They just jump straight to the annuitization phase.
Exactly. They hand over $2 million on a Tuesday, and the insurance company starts sending them a monthly retirement check the very next month.
Quick turnaround.
Right. But whether you accumulated the money over 30 years or deposited a lump sum yesterday, once you annuitize, you have to make some permanent, life-altering choices about how you want that payout to work.
Okay, these are the annuity payout options, or the types of election.
Yes.
And if you are studying for the Series 7, you absolutely have to know the difference between these options.
It's guaranteed to be on the test.
Because the option you pick dictates how much risk the insurance company is taking, which directly dictates how big your monthly check will be.
Precisely. The actuaries are pricing the risk. Let's start with the option that puts the least amount of risk on the insurance company, which therefore gives you the highest possible monthly payout.
Okay, what is it?
Life only.
Life only, sometimes called straight life. What does that actually mean?
It means the insurance company guarantees to pay you a monthly check for as long as you breathe. If medical science keeps you alive to be 110 years old, they keep paying. But the very second you die, the payments stop forever. Period.
Let me make sure I understand the brutality of this.
Go ahead.
If I annuitize $1 million on a Tuesday,
Okay.
I get my first $3,000 check on a Friday,
Yeah.
and then I get hit by a bus on Saturday. The insurance company just keeps the remaining $997,000.
Yes. They keep every last cent of it.
My spouse, my kids, my heirs, they get nothing.
Your heirs get absolutely nothing.
That is wild.
Because you chose life only, you made a pure, unhedged bet on your own longevity.
Right.
The insurance company pools this risk across thousands of annuitants. The people who die early, like the guy hit by the bus, leave their money in the pool, which subsidizes the payouts for the people who live remarkably long lives.
Ah, I see.
Because the insurance company takes on the least amount of risk with this option, meaning they only have to track one lifespan, and when it ends, their obligation ends this option, provides the largest possible monthly check.
Psychologically, that is a really tough pill to swallow for a lot of people. The idea of leaving nothing to your kids if you die prematurely is terrifying.
It is, which is why, in the real world, most people do not choose life only.
What do they choose?
They usually choose an option with some kind of safety net for their heirs, like life with period certain.
Life with period certain. Break that down for me.
This option still guarantees you a paycheck for the rest of your natural life.
Okay, good.
But it adds a period certain guarantee, usually 10, 15, or 20 years. Let's say you choose life with a 10-year period certain.
Okay.
If you live for 30 years, you get paid for 30 years.
Okay, that sounds just like life only so far.
But here's the difference. If you die after just 3 years, the insurance company is legally obligated to continue making those exact same monthly payments to your named beneficiary for the remaining 7 years of that 10-year guaranteed period.
Okay, so the insurance company is guaranteeing they will pay out for at least 10 years no matter what.
Exactly.
Whether it goes to me while I'm alive or to my kids after I'm dead, 10 years of checks are going out the door.
That's the guarantee.
But because I forced the insurance company to take on that extra guaranteed risk,
Yeah.
my monthly check while I am alive is going to be smaller than if I had chosen life only.
Exactly. The actuaries reduce your payout. You are buying peace of mind for your heirs, and the cost of that peace of mind is a permanent reduction in your own monthly income.
What about married couples? Because they usually want to make sure the surviving spouse is taken care of.
They typically choose the joint and survivor option.
How does that work?
This guarantees payouts will continue as long as either spouse is alive. The checks do not stop until the second spouse passes away.
And because the insurance company is now betting against 2 UBO lifespans instead of 1, and, well, women statistically outlive men, the actuarial risk is much higher.
It's significantly higher.
So that monthly check is going to be the smallest of all the options we've discussed.
Mathematically, yes. It has the longest expected payout period, so it results in the smallest monthly payout.
Okay, so I navigate the options. I pick my payout structure.
Right.
Now we have to address the elephant in the room. Because this is a variable annuity,
Yeah.
that monthly check isn't a fixed guaranteed dollar amount like a traditional pension, right?
Correct.
The size of the check fluctuates based on the performance of the separate account.
It does. And this brings us to what is easily one of the most notoriously confusing concepts on the Series 7 exam.
I know exactly what you're going to say.
The assumed interest rate or the AIR.
The AIR. I am looking at my notes on this, and honestly, my eyes are crossing.
It's tough.
It says here that my check can go down even if my account goes up. That defies basic math. Explain this to me like I am a completely exhausted test taker who just wants to understand the mechanics of this variable payout.
Okay, let's take it step by step. When you annuitize, the insurance company locks in a fixed number of annuitization units.
Okay, units are locked.
Right. Let's say based on your age and account balance, they assign you 1,000 annuitization units. That unit count will never, ever change for the rest of your life.
My unit count is locked in stone. 1,000 units.
What does change is the dollar value of each of those units every single month, based on how the stock market performs.
Okay.
To determine if the unit value goes up or down for your next check, the insurance company establishes the assumed interest rate, the AR.
So what is that exactly?
Think of the AR as an arbitrary benchmark, a target rate of return that the actuaries select when you sign the contract. Let's say they set your AR benchmark at 4%.
Okay. I have my 1,000 units and my AIR benchmark is 4%.
Now, every month, the insurance company compares the actual rate of return of your separate account investments against that 4% ARR benchmark.
Okay, I'm trying to visualize this. I like to use an analogy for this one.
Let's hear it.
Let's compare the assumed interest rate, the AR, to the speed setting on a treadmill.
A treadmill. Okay.
Let's say you program the treadmill to a constant speed of 4 miles per hour. That is your AR benchmark. It never changes.
Right.
Your actual investment return in the stock market is how fast your legs are physically running on that treadmill.
I like this. Walk me through the scenarios.
Okay, scenario 1. The stock market has a great month. Your actual return is 6%. Your legs are running at 6 miles per hour. The treadmill belt is only moving at 4.
So you're running faster than the belt.
Right. What happens? You physically move forward on the treadmill, your next monthly check goes up.
Exactly right. The rule for the exam is, if actual return is greater than the AR, the next check increases.
Scenario 2. The market has an okay month. It returns exactly 4%. Your legs are running 4 miles per hour, and the treadmill is moving 4 miles per hour.
You are in perfect equilibrium.
Right. You don't move forward, you don't move backwards, you stay exactly in the same spot.
Correct. If actual return equals the AIR, your next check stays the exact same dollar amount as the previous month's check.
And here's scenario 3, the one that catches absolutely everyone off guard and makes them fail the practice test.
The tricky one.
Let's say the market has a positive return next month. The account grew by 2%. I made money.
Right. Positive return.
But the treadmill, the AIR, is rigidly set at 4. My legs are running 2 miles per hour, but the belt is moving 4.
You're running slower than the belt.
I am losing ground. I am drifting backwards, so my check is going to go down.
That is the critical counterintuitive concept you have to master. Your monthly check can go down even in a month where your underlying investments had a positive return, simply because your actual return was less than the AIR benchmark. If actual is less than AIR, the check goes down.
So the size of the check is constantly adjusting month to month, purely based on whether the actual return beat, matched, or missed that rigid AIR benchmark on the treadmill. It's all relative.
That is exactly how it works, and exam writers love testing that exact relative relationship.
Oh, I bet.
They won't ask you to calculate the complex math, They will give you a directional scenario.
Like what?
They will say, month 1, actual return is 6%, ARR is 4. What happens to the check?
It goes up.
Month 2, actual return is 4, ARR is 4. What happens?
It stays the same as month 1.
Exactly. It's a very mechanical, logical process once you understand the treadmill rule.
Okay, I think I survived the AIR treadmill. So I am getting this fluctuating monthly check. Sometimes it's bigger, sometimes it's smaller, but it's coming in every month.
Right.
It sounds great to have a lifetime income stream.
Right.
But we live in reality, and Uncle Sam always wants his cut of any income stream.
Yes, he does.
How much of this check is actually mine to keep, and how much goes to taxes?
Which transitions us perfectly to the reality of the tax code. We need to look at the tax implications at payout and surrender. Let's start with those monthly annuitization checks you are receiving.
Right. Because I originally funded this annuity with my own money. Money I had already paid income taxes on from my salary. It was after-tax money.
True.
I shouldn't have to pay taxes on that principal again. That would be double taxation.
You don't. The IRS recognizes that.
Oh, thank God.
When you receive an annuity payout, the IRS uses a specific formula called the exclusion ratio to determine how much of that check is simply a return of your original principal and how much is the actual growth, the earnings.
So they essentially split every single monthly check into 2 distinct pieces.
Yes. They tax it on a pro rata basis. The portion of the check that represents your original principal is returned to you completely tax-free. It's just your own money coming back to your pocket.
Well,
The portion of the check that represents the earnings, the growth from the stock market over the decades is the taxable portion.
and how is that earnings portion taxed? Because my money was invested in the stock market in the separate account. Do I get to use those sweet, favorable, long-term capital gains tax rates that are much lower?
No, you do not.
Ugh.
And this is a massive structural point. All earnings distributed from an annuity are taxed as ordinary income.
Ordinary income. Like the salary from my job?
Exactly like your W-2 salary.
That hurts.
This ordinary income tax treatment is a critical negative factor for variable annuities that critics and fee-only financial planners constantly point out.
I can see why.
Yes, you get the tremendous benefit of tax deferral while the account is growing during the accumulation phase. But the painful trade-off is that you completely lose the favorable long-term capital gains tax rates that you would have received if you had just held those exact same mutual funds in a normal brokerage account.
So for a high net worth investor, ordinary income tax rates can be significantly higher than capital gains rates.
Absolutely. It can be a huge difference.
Okay, so that's how the taxation works if I play by the rules and take the pro rata monthly payout.
Right.
What if I don't annuitize? What if I am 55 years old, my account has grown a ton, I don't want a monthly check, and I just want to cash the whole thing out? I want to withdraw a lump sum to buy a beach house.
If you do a lump sum surrender or even just a partial lump sum withdrawal, the tax rules change entirely and they become incredibly punitive.
Punitive, great word.
The IRS treats lump sum withdrawals from an annuity on a LIFO basis, LIFO.
Last in, first out.
Last in, first out. What does that actually mean in plain English for the person trying to buy the beach house?
It means the IRS assumes, for tax purposes, that the very first money you take out of the account is all of your taxable earnings.
Oh, no.
Yes. The last money that conceptually went into the account, the growth, is the first money to come out.
Let me put some real numbers to this to make sure I understand the pain level here.
Let's hear it.
Let's say I put in $100,000 of my own after-tax money originally. Over 15 years, the account grew to $250,000.
Okay, good growth. So my buckets are 100 grand of principal and 150 grand of earnings.
Correct.
I go to the insurance company and say, hey, I want to withdraw $50,000 in a lump sum to remodel my kitchen.
Right.
Because of the LIFO rule, the IRS says that entire $50,000 is coming straight out of my $150,000 earnings bucket,
That is exactly how they view it.
which means every single penny of that $50,000 is going to be fully taxed as ordinary income on my tax return this year. I don't get any of my tax-free principal back until I have completely drained all $150,000 of earnings.
Every single penny is taxable.
That is terrible.
If the tax code had been FIFO first in, first out, you would have been pulling from your original tax-free principal first, and you wouldn't owe a dime in taxes on that kitchen remodel.
Why do they do that?
The government deliberately set annuities up as LIFO. The policy goal was to aggressively discourage people from using tax-deferred retirement accounts as short-term, tax-free piggy banks.
And wait, earlier I said I was 55 in this scenario. Isn't there an age-related penalty here too, just like an IRA?
There is. Because annuities are legally classified as retirement accounts and receive that special tax deferral, they fall under the exact same age rules as an IRA or a 401k.
Okay.
If you withdraw money before you reach the age of 59 and a half, you don't just pay ordinary income tax on the earnings. The IRS hits you with an additional 10% early withdrawal penalty on the taxable amount.
Wow. Let's look at the carnage of this scenario.
It's bad.
I pull out 50 grand for the kitchen because it's LIFO, it's all taxable, it bumps me into a higher tax bracket because it's ordinary income.
Right.
Then I lose another 5 grand right off the top to an IRS penalty because I'm under 59.5.
Correct.
And D, if I'm still inside the first 7 years of the contract, I might still have to pay a surrender fee to the insurance company.
It is a complete financial bloodbath. If you touch an annuity the wrong way at the wrong time, the fees and taxes will absolutely decimate your wealth.
Okay, I have to synthesize everything we have talked about so far because I feel like I am experiencing whiplash.
It's a lot to take in.
We have incredibly high internal fees, sometimes dragging the portfolio by 3% a year.
Yep.
We have strict punitive surrender penalties that lock up my money for 7 to 10 years.
Yes.
We completely lose the capital gains tax treatment, so all our long-term growth is taxed at much higher ordinary income rates.
True.
And if we touch it too early or take a lump sum, the IRS smacks us with LIFO taxes and a 10% penalty.
Every single point you just made is factually correct. It is a highly restrictive environment.
So my obvious question is, if I am an ethical financial advisor, when do I ever actually tell a human being to buy one of these? Why does this industry even exist, let alone manage trillions of dollars?
This raises an incredibly important question about ethics and regulation, and it is the exact question that state insurance commissioners, the SEC, and FINRA spend their entire days investigating. Which brings us to the final and arguably the most crucial section for anyone taking a licensing exam or working in the field. Suitability.
Suitability. Because in the highly regulated securities industry, you can't just sell a complex investment to a client simply because it earns you a massive 7% commission.
No, you absolutely cannot.
You have to be able to mathematically and situationally prove that it is appropriate for that specific human being's financial profile.
Exactly. And because of everything you just summarized, the high fees, the strict lack of liquidity, the complex tax structure, and the steep commissions, variable annuities are among the most heavily scrutinized financial products on the market regarding who can actually be sold them. Regulators are constantly watching.
So what's the rule?
The overarching principle for recommending a variable annuity is what I call the last resort rule.
The last resort rule. That implies a checklist of things that have to happen first.
Exactly. Variable annuities are absolutely not suitable for a client until all other cheaper, more efficient, and more liquid retirement and safety options are fully funded and maxed out.
Okay, walk me through that suitability checklist. What buckets have to be completely full before an advisor can even utter the words variable annuity?
First and foremost, a client must have already maxed out their workplace retirement plan like their 401k or 403b.
Okay, why?
Because a 401k gives you the exact same tax deferral, usually comes with an employer match, which is literally free money, and crucially, it does not have the massive 3% insurance fees dragging it down.
Okay, makes total sense. 401k is maxed. What's next?
Second, they must have maxed out their annual IRA contributions. IRAs offer tax advantages, but give the investor a much wider, cheaper universe of investment choices without the insurance wrapper.
Right. Okay, what's third?
Third, they must have established a highly liquid, easily accessible cash reserve for emergencies.
Like a savings account.
Typically 3 to 6 months of living expenses sitting in a basic bank account. You do not, under any circumstances, put emergency money into a product with a 7-year surrender charge.
Right, because if the roof caves in or you lose your job, you need that cash tomorrow morning without paying a 10% IRS penalty and a 7% surrender fee.
Exactly. And fourth, they must have already secured adequate basic life insurance, like a cheap term life policy to protect their family's immediate income needs.
So 4 buckets.
Only after those 4 buckets are completely full, the 401k, the IRA, the liquid cash reserve, the basic term life insurance, should a variable annuity even enter the conversation.
Wow.
It is meant to be a supplemental retirement tool for high net worth individuals who have exhausted all other tax advantage space and still need more tax deferral.
You know, I always compare building a holistic financial plan to getting dressed for a blizzard.
Okay, I like your analogies. Let's hear it.
A variable annuity is like a very heavy, very expensive, highly specialized winter coat. It is an incredibly useful, powerful tool to keep you warm when the conditions are extreme and you are facing a long journey. But you do not put it on as your first layer.
That is a perfect, practical way to visualize the suitability hierarchy.
You put on your undershirt first, that's your liquid cash reserve. You put on your sweater, that's your fully funded 401k and IRA. You put on a light jacket over that, that's your basic life insurance policy.
Yep.
If you have all of those layers on and you look at your financial situation and say, hey, I still have more money I want to invest. I still need more tax-deferred growth because of my tax bracket, and I still want downside protection.
Then you reach for the coat.
Then, and only then, do you put on the heavy winter coat. You buy the variable annuity.
And if you, as a licensed broker, sell that heavy winter coat to someone who isn't wearing an undershirt, you are going to face severe disciplinary action and potentially lose your license.
Really?
Regulators actively hunt for brokers who sell high-fee variable annuities to the wrong demographic.
Give me a real-world example of the wrong client. What is a classic suitability violation that pops up on the exams and FINRA enforcement actions?
The exam writers love to test this concept via case studies.
Let's hear one.
The most classic, heavily prosecuted violation is selling a variable annuity to an elderly client, say someone who is 75 or 80 years old, who is living on a fixed income and might need immediate liquidity to pay for upcoming medical bills or a nursing home.
Right, because by selling them an annuity, you just locked up the remaining life savings in a product with a 7-year surrender charge.
Exactly.
If they need cash for a surgery in year 2, they are trapped.
Exactly. It is highly unethical and illegal. Another classic violation is selling a variable annuity to a 25-year-old who hasn't even opened a basic IRA yet.
Oh, man.
Why on earth would you saddle a young person with 3% annual M&E fees and surrender charges when they could just buy a cheap S&P 500 index fund in a Roth IRA for practically 0 fees?
But wait, earlier we talked about age factors and time horizons.
Hmm.
Generally speaking, if a client has maxed out all those other buckets and they are a suitable candidate,
Right.
younger investors are better suited for variable products, while older investors might lean toward fixed products, right?
That is generally the correct rule of thumb. A younger investor, say a high-earning professional in their 40s who has maxed out everything else, has a long time horizon.
They have time.
They have 30 years to ride out the inevitable market volatility in the separate account. That long time horizon gives the power of tax deferral enough time to outpace the drag of the internal fees.
Okay, that makes sense.
An older investor in their 70s, however, doesn't have the time to recover from a sudden market crash, so they are much better suited for the guaranteed, stable returns of the general account found in a fixed annuity.
So if I am a financial advisor, how do I actually prove to the regulators that I followed these rules? If FINRA is watching this closely, I can't just take a client's word for it that they have a cash reserve.
You have to extensively and meticulously document the client's profile.
Paper trail.
A huge paper trail. You must record their exact risk tolerance, their specific investment time horizon, their stated liquidity needs, and their complete financial picture.
Like their income, net worth, existing assets.
All of it, before you can legally recommend the purchase or the exchange of these contracts.
Ah, the exchange.
Yeah.
You mean moving money from an old annuity to a new one?
Yes, formally called a 1035 exchange under the tax code.
1035 exchange.
It allows you to move from one annuity to another without triggering taxes. Historically, unethical brokers used to aggressively move clients from one annuity to another every few years just to generate a massive new commission for themselves,
Oh, wow.
completely resetting the client's 7-year surrender charge period all over again. It was called churning.
Churning. That's terrible.
Regulators cracked down on that heavily in the early 2000s. The documentation required today to prove that an exchange is actually in the client's best interest and not just a payday for the broker is immense.
It really emphasizes that these products are tools. And like any heavy-duty power tool, in the hands of a skilled craftsman who uses it for the right job, it is incredibly effective and serves a distinct purpose.
Very true.
But in the hands of someone who doesn't know what they're doing or someone acting unethically to line their own pockets, it can cause catastrophic financial damage.
That is the perfect summation of the entire variable annuity landscape. They are complex, powerful, and dangerous if misused.
Okay, we have covered a massive amount of ground today. We started at the very foundation, drawing a hard line between the conservative, guaranteed general account and the volatile, legally protected separate account, the off-road vehicle of the insurance world.
We explored the thick insurance wrapper, the death benefits that protect your heirs from a market crash, and the living riders like the GMB that provide a phantom floor for your retirement income. And we broke down the heavy M&E fees and surrender charges that pay for those exact guarantees.
We watched our money grow during the accumulation phase, navigating accumulation units, net asset values, and the massive compounding power of tax deferral. Then, we made the irrevocable shift.
We annuitize.
We turned those accumulation units into annuitization units, and we finally understood how our fluctuating monthly check is entirely at the mercy of the assumed interest rate, that rigid ARR treadmill.
We navigated the punitive tax traps, the ordinary income tax rates on payouts, and the devastating LIFO tax treatment and 10% IRS penalties if you try to treat the annuity like a short-term bank account.
And finally, we established the golden rule of suitability. The variable annuity is the heavy winter coat. It is the last resort, only to be utilized after every other tax-advantaged and liquid bucket is completely full.
It is an incredibly complex ecosystem, but when you break it down into its component parts, the internal logic of how it operates and why it costs what it costs becomes very clear.
I think we have successfully decoded the muddy waters and made sense of the jargon. But before we sign off, I want to leave everyone with one final thought, something to really chew on as you look at your own portfolios and think about the broader landscape of modern retirement planning.
If we look beyond the high fees, beyond the complex LIFO tax rules, and beyond the rigid surrender charges, there is one undeniable mathematical reality that makes annuities totally unique in the financial world.
What's that?
It is the concept of longevity risk.
Longevity risk, the very real risk of simply outliving your money.
Exactly. We are living in a remarkable era where medical science is pushing average life expectancies further into the 80s, 90s, and even the hundreds.
It's amazing.
If you just have a standard, fee-efficient brokerage account filled with mutual funds, you can do all the math in the world. You can meticulously follow the 4% withdrawal rule.
Right.
But there's always a mathematical possibility, especially if you hit a bad sequence of returns early in retirement, that you will drain that account to zero while you're still very much alive.
And if that happens at age 90, you have nothing left but Social Security to survive on.
Right. But a variable annuity, specifically if you choose that life-only payout option, is one of the only financial instruments on the planet outside of a traditional corporate pension or Social Security that can legally guarantee you a paycheck for as long as you breathe.
Wow.
Even if you live to be 110 years old, even if the actual account balance hits absolute zero because you live so incredibly long, the insurance company is legally bound to keep cutting you a check every single month.
It fundamentally transfers the financial risk of living a really, really long time from your frail shoulders to the massive balance sheet of a multi-billion-dollar insurance company.
So the ultimate question you have to ask yourself, or the question you must pose to your clients if you are an advisor, is this. As the fear of running out of money becomes the #1 documented anxiety for modern retirees, will the mathematical peace of mind provided by that guaranteed lifetime payout ultimately outweigh the frustration of the high fees it took to secure it?
That's a heavy question.
There is no right or wrong answer. It is a deeply personal question, but it is one that will absolutely define the future of retirement planning for a generation.